Hey there, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Wonderful to see you all once again. Happy Monday. It's a beautiful day. The sun is shining. Maybe it's a little cold in some places. Maybe it's a little warm in other places, depending on where you're watching. But in any case, it's looking like, of course, it always is, right? An interesting week in the markets and potentially an interesting week for GameStop. Potentially not some of the volatility that we've been used to seeing in GameStop, but that is typical of this portion of the volatility cycle, right? So this type of cycle, this type of sequence of price action behavior that corresponds to changes in volatility, that corresponds to changes in liquidity, very similar to this pattern described by Gherkinit, Reddit user Gherkinit, in his When the River Runs Dry due diligence. Maybe not quite linked up to OPEXs all the time, but it does seem in this case that we are moving into at least an OPEX sequenced cycle this time around. We've been talking about this for several weeks. So what are we going to be talking about today? Obviously, there's some question marks on the horizon looking at some of this downside movement. We're seeing GameStop correspond a little bit with this much bigger downside movement in the markets more broadly. So we're going to unpack maybe a little bit of what's going on there. Think about what that means for us going forward. Is this reason for some more major concern? What does this really say? So that's what we're going to be thinking about today, heading into this week. For those of you who may be joining us for the first time, I publish daily GameStop analyses, both in context through technical and options analytical methods. I publish that on my X page every day pre-market. If you haven't had a chance to check that out yet, you can find it linked down in the description here on my YouTube page. If you're watching this on YouTube, if you're watching this on X, of course, it's pinned at the top of my profile. So yeah, so let's get into this today. Very interesting, right? Are we looking at that stall that mentioned the end of last week? Is that finally kind of unwinding now? Are we getting a phase of this yen carry trade unwind, something like that? What's really going on now, right? All of a sudden, we're seeing all this downside volatility start to brew up in markets. Not crazy stuff, right? Not, kind of near record levels like we saw last August, but 2.5% move down in SPY kind of overnight after 3 consecutive days of hitting all-time highs is certainly the thing to behold. So what's going on there? Are we really going to be looking at more downside? Like, didn't the end of last week everything kind of looked like people were betting optimistically going several weeks out? Yeah, all of that's still true. Although it does look like a number of puts kind of came on the board last week, end of last week. Some calls came off the board, but in any case, we're seeing a lot of volatility realizing. Of course, people can't reposition in the pre-market period right now. So we'll take a look at these charts in a bit and think about how that has and how that will affect GameStop going forward. Let me give shout out and thanks to Go Zuback for sponsoring today's breakdown and research, as well as to Dat Scruffdo. Scruffy, thank you so much as always for your support, and thanks to everyone who has supported and has supported in the past, will support in the future. Thank you so much to everyone. So yeah, we're still waiting, right? We're still waiting on something. It seems to happen. This Roaring Kitty meme from last week still continues to sum up the mood quite well. Waiting, something like that. In another sense, right? I was looking at this weekend and I thought too, like, oh hey, like, it's interesting that whenever Roaring Kitty had something to say about a dog in the fall or in December, something like that, right? Whenever he had this kind of dog meme, everybody was like, oh, Chewy, right? Because he was trading Chewy. He had a very large position in Chewy. But now all of a sudden he has another dog meme, but now nobody cares about Chewy anymore because, he filed his 13G and sold his shares. But very interesting to see that kind of Chewy has been trading up on a pretty stable technical pattern that looks a lot like what we were seeing in GameStop, basically from October all the way up through the end of the year. And GameStop, of course, is retraced to the downside, where Chewy is just chugging on up to $40. So I don't know. This is something cosmetic, something aesthetic, but another dimension I haven't seen pointed out too much. But in any case, I think it does sum up the mood quite well in what we've seen over the past week and what we're seeing this week. So yeah, SPX moving to the downside, certainly moved to the downside pretty quickly early on. What it looks like going into things today, SPX and SPY, I should just say the S&P, kind of these, right? SPX is the S&P at 10x leverage, but it can still be useful to track how the options market's going. Yeah, so 590 here, we have this level in SPY. Lots of trader bought puts, a lot of dealer positive gamma, meaning so as the price goes down into where these bought puts are accumulated, dealers are going to dealer positive gamma is going to ramp up, which means they're going to sell more shares in order to remain delta neutral, delta and gamma neutral, approaching that position. So because we have this is big, right? As we if we were to slip through this level here, it would really ramp up volatility pretty quickly if we were to move through there. However, what we saw here in the pre-market, let's move down a little bit to one of our charts here, is if we take a look here. Right, so this is our 4-hour chart. Sold very quickly, right? Gap down, and then in the overnight XDO period and in our pre-market trading, moved down very quickly, right here. So no options can be bought or sold here. So they remain static throughout this period. Hedging continues. Market makers will continue to hedge their positions in the overnight market, and well, hopefully not too much in the overnight market. I don't exactly know how that works in the overnight market. I imagine there's far less liquidity, but to a certain extent, they're probably still hedging that. But certainly in pre-market, they've certainly displayed this behavior in the past, that they can do this. Obviously, right? They do this by buying and selling shares, by shorting shares, and buying them back. So what we did here is we moved, we slipped right on down right there to that 590 position and then bounced off of it. So this is something that SpotGamma refers to as a put wall. So whenever you have a huge accumulation of trader bought puts, you have this particular dynamic where there can be a bounce off of this as IV values shift. So implied volatility in the S&P spikes as the price moves downward toward these more volatile positions, toward these more put heavy positions where they're trader bought puts and dealer short puts. But once that's realized, right? So once that gamma gets realized, then on the other side of that, volatility goes down, right? So implied volatility is volatility that is expected or anticipated based on potential upcoming moves. But once those moves have been realized, so once that gamma has been realized, that gamma hedging down to this level has been realized, there isn't a lot of volatility, right? The implied volatility is then also realized. Like that was the move that could have happened that did realize. So the implied volatility is going to go down. And right, market makers are tracking this all the time, even in pre-market trading, even though people aren't buying and selling puts and calls. They're still tracking, right, all of the Greek values of these contracts, even though the contract numbers are staying stable, are varying in pre-market trading, right? So dealers are tracking this all the time, and they're hedging accordingly. So what happens is as we move down there, that gets realized, and there isn't the same implied volatility appreciation element, right? So volatility isn't spiked. It spikes up to this point, but then it's been realized, it's been hedged. And so as I understand this, based on how SpotGamma explains this, there is a Vanna component. So delta change in terms of IV. So Vanna is the fake Greek letter that tracks delta changes in terms of IV. So once you get that IV realized, IV no longer spikes on account of that position. And as we saw up at this chart here, So we do just below 590 in SPY. We have like 589. So in this region, right? So this is where we're going to get the biggest implied volatility spike, right? So IV is going to go up, 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 right? As we approach this big position. But then that's kind of the biggest put gamma position around for a while, right? At 780,000 and 419,000 points of it underneath there. But as we get into here, right, all the IV spiking that was like, ooh, this could go, we could move here, this could get real, all this hedging could get realized, right? This hedging is getting realized through these positions. And then most of the gamma hedging is realized here on the other side of this. That's not necessarily going to happen. So then IV is going to go down. You're going to get a reduction in IV. So then dealers then buy back they would buy back their Vanna hedges, right? So they are gamma positive. Because traders are gamma negative. Traders are gamma and delta negative for these puts, these long puts. So they're short the dealers. So dealers for those puts are gamma and delta positive, meaning that they're buying shares. They're selling shares as that position is approached. But as then the implied volatility then decreases, then they buy back some of the Vanna hedges that they had just sold at that level. So that can be enough sometimes, right? As I understand it, that can be enough to generate a bit of a bounce. And if you have a really big put position, this is you can get a kind of a bigger bounce in that sense, depending on how traders are usually traders take that as well. So it'll function as a bit of a stall, but traders can then come on top of that, right? So it's not that like, okay, the price hits that and then it bounces and then hedging takes it back up. No, not necessarily. It hits that level, it'll stall, and then if traders come in, they can pick up that stall and then move it back in the other direction, and then hedging will kind of move it back up the chain a little bit. So it does look like that occurred, right? And again, this is my understanding from how spot gamma presents this concept, the put wall concept. It does look like that is what occurred down on this chart in the pre-market. So right, in fact, this is back a little bit earlier. This was back when our price was around 593 at the time of this video. We've already kind of walked back up here even more in terms of the broader market. Where are we? SPY. Yeah, back up to 595. So it's not a crazy recovery, but it did move back up close to 1% off of that bottom there. So like maybe 0.8, 0.85, something like that. So I mean, where would it be? It might deflect again off of this, right? It moved back up above this moving average. That doesn't seem to have functioned as a navigation point within this landscape. I think those options key levels are what's really more predictive in terms of what's going on there. Yeah. So what I think this keys us into, although we still have that risk there, if we don't, we'll open soon. If we don't recover too hard, then it's possible traders might go ahead and take profits on those puts, right? They can't do anything with those puts now, but traders who entered into all these long puts, as we tested these all-time highs end of last week, they're now in a position, right? Their puts, if they had puts at, we saw a lot of puts build up in the middle of the day around this like 60.75 level, 60.50 level, things like this. There were a lot of calls that Spot Gamma points out to as part of this iron condor trade that somebody kept doubling down on last week as they got blown out with these all-time highs, like max loss on this iron condor trade every single time we went to these all-time highs. So that came off the board. So a lot of short-dated calls came off the board with that. Yeah, and what it looks like, what could happen as a result of this is traders may look to take profits on those puts, and as they do, this would then allow dealers to go ahead and buy back short hedges for those short puts that they've sold to traders for this occasion if traders take puts, right? That's a lot of back and forth there, but something like that. And if that's the case, then traders accordingly would know, okay, got to come. Let's come in. Let's take advantage of this upside move. Let's buy short dated calls. This is not trading advice. I'm not telling you to go do that. I'm just saying this is something that experienced traders who are plugged into these metrics, who do have more advanced knowledge access, this is something they might do in order to capture value off of that move back to the upside. So we may see a bit of a recovery. What again? Now the issue now is the stability we had in this, say, 6,000 or this 5950 SPX level up to like 6,100, the corresponding levels in SPY. We don't right now have that same level of stability. We're more shifted in terms of puts right now. So things are more neutral, a little bit more volatile. Again, as long as we kind of stay above that 50-90 level in SPY, we're not looking at say a more critical price collapse down into this lower bottom like we did about a week and a half ago, 2 weeks ago. But there's still potential here. I think there's probably, in the very short term, we're looking at something of a bounce back up to the immediate upside. Before then, we would continue back to the downside, and that's gonna, again, that's not me saying like, well, it matters what I think. What I'm saying is, it seems to me this is how traders would play this situation, and much of this is going to depend on how traders actually do come in and purchase new options contracts heading into this week. If they buy enough, right, then we might stabilize coming out of the Fed meeting this week on Wednesday. But again, right, we don't necessarily have to. Okay, so right, great. Market context, amazing, Michael, crazy, thanks. What does this have to do with GameStop? Right, so I've started paying attention to some of these contextual factors because as we've seen and as we've noted, especially over the last few weeks, when the market is in more volatile conditions, when we are moving to the downside in the general market, it seems that these are conditions that make it easier for institutions to short GameStop. It's easier for them to get access to liquidity, to use that liquidity to short GameStop, to suppress GameStop's volatility, right? GameStop's volatility works inversely to how it works in SPY, inversely to how it works in the broader market indices. In the market, volatility spikes when the price goes down, right? So there's an inverse correlation. When it comes to GameStop, when the price moves up, volatility goes up. So volatility and the price are directly correlated when it comes to GameStop. So accordingly, when there's high liquidity, institutions can short, and this reduces volatility. So as liquidity goes up, volatility goes down. As liquidity comes down, volatility goes up. So what we saw heading into the end of December, heading into early January, right? We talked about this a lot here. We were in a liquidity crunch in terms of lendable shares per Interactive Brokers. We got down at some point to only about 100,000 shares, right? That's a far cry from where we are now. We're still over 2 million shares of that can be borrowed for shorting. So if we see what I think is going to happen, if we see this recovery in terms of traders going ahead and closing some short dated puts, which were basically open to hedge this move off of the Bank of Japan, if we rate this rate hike, if they go ahead and close this and open calls to then capture profits off of the hedging reaction to them closing their puts, then GameStop would then have at least some short-term stability built into the broader context in terms of protecting against some deeper downside. We did see some reactions in GameStop early, right? So heading into Friday, we saw the beginning of this downside move. A lot of this, right? The first half of the day, we traded actually pretty flat, right? We had a channel formed by the upper resistance level, so the resistance line of our bearish regression channel that we've been in for about the past 2 weeks, and the resistance line of this very small kind of range bound channel that we've been trading in for about a week. So we stayed right? Let's blow this up a little bit so you can see better. Right, we just traded within this and then off of VWAP and this kind of cluster of moving averages. So, right, traded up, went above it. It was actually, it's angled a little bit down more now, but it was basically running right up here at that time. And I redraw these periodically so that they right, so they line up going forward in time. But that's right, basically went up here, tested this resistance level, found support, stuck up here, traded off of the volume weighted average price, traded down again, and then toward the end of the day, basically, right, so this is about noon here. What happened after noon? There was basically no volume, right? Nobody was trading the stock. Nothing was really happening in the options market. A lot of traders earlier, so on Thursday, right? So after we got this tweet, this post very late from Roaring Kitty at on Wednesday, 8 p.m. Eastern time, the opening of the overnight market, the price spiked up. The price traded up on a volume weighted average price order. It looked like on Thursday, possibly to close out some FTDs from all the way back in. Yeah, all the way back in December, probably all the way back on December 19th, something like that. We had 333,000 fails then. So, maybe something like that drove it, but we had this volume weighted average price order. It traded us up. Our IV spiked a bit, not crazy, but enough, right? We went up about 13 percentage points on the day. And that was that's a huge opportunity to go ahead and short contracts. We talked about this at the live stream on Friday too. Like this is what they do. This is how traders come in. This is how institutions come in and sell volatility, right? They look at these little snapbacks, these quick little snapbacks. We'll see, in a matter of minutes, in the matter of like 20 minutes, we'll see these really big appreciations in the implied volatility. They understand that they're still in a general depreciative IV context, and then go ahead and then start piling on short calls, start unloading these, right? They exploit euphoria on behalf of the broader options market, especially because retail investors typically go single leg options, and they tend to chase momentum. So, right, they kind of do the opposite of what the institutions do. They kind of sort of do the opposite of the ideal move. They act on what's happening, not on what they expect to happen next. So institutions will take advantage of this euphoria as traders chase momentum, right? They kind of FOMO into these positions, sell them calls while IV is up. And then immediately they anticipate that, well, okay, whatever this volume weighted average price order is, it's going to run out, around this price. And then we're going to move back down to the downside. IV is going to go with it. We'll dump a few 100,000 short shares on top of it to encourage it to move down. That's exactly what they did on Thursday. Here we came out, we traded flat, and then simply there wasn't trading. More experienced institutional traders happy to just sit on their short call positions and then watch them pick up value, while in the second half of the day here, charm that is delta decay over time set in with these out of the money calls, especially out of the money calls, and just walk the price down. So over time, delta will decay, especially on out of the money options heading into the end of the week. As you head into expiry, those delta values on those out of the money contracts are really going to start dying pretty quickly. They're going to bleed a lot, and that's accordingly going to afford dealers the privilege to go ahead and get rid of the long shares that they were holding in order to hedge those short calls on their books. So that's basically what we saw, just kind of peter out there into the close. Okay, so then today, right, we instantly sold off, instantly opened down from this. Well, I should say even last night, right? So this would have been when the overnight market opened last night. This sold down, was kind of flat, and then sold down early today as SPY continued to do its thing, right? So this is what I mean when it's important to take into context what is the broader market doing, because this can be used as either as a cause, right, a sort of casus belli to go ahead and short the stock, or a way to something like, right, as the broader market trades down, ETFs that contain GameStop will sell shares, right? They will, rebalance their portfolios based on, based on how the broader market is performing. And as they do so, there's going to be this kind of patina of of downward pressure that then makes something like direct shorting of the stock more effective, since it's easier for it to pick up momentum, something like that. So right, we started to trade down there, but then yeah, we've already started to recover a bit as the broader market has recovered. It's trading pretty much in line with what's going on with SPY right now. So what's going on there? Are we anticipating, does this mean, uh-oh, we're in trouble, time to panic? I would say largely no. I would say my expectations heading into this week are not that different from what they were heading into last week. We ended up kind of slightly higher than I thought we would be heading into the end of last week, largely because of Roaring Kitty coming in with his post and however the market reacted to that. But as you can see, right, we largely stayed within the bounds of this bearish regression channel. We flirted with this top line a bit here, but didn't really go anywhere. We had a chance to exit it here with our range bound trading. We didn't. Then we, sort of continued to retrace technically down here. We're just about, not quite to the midline of this channel. Okay, so tracing down in a bearish regression channel, does that mean, okay, we're heading for the bottom support line here? Does that mean we're going to $24 or $23? No, not necessarily. I would not expect something like that until we can log a lower low, and we haven't done that yet. Even with this big downturn in SPY, right? We haven't logged a lower low. We're trading kind of in the upper 26s pre-market right now. 26.33, I think, is our low within this trend. So until we can log a lower low, I wouldn't directly assume that we would dig deeper. We may still go ahead. It's still going to be a conflict between, like, okay, do we have more bearishness left in us? Richard Newton, of course, this last weekend and heading into this weekend, talking a lot about 127, talking about today as being this potential swap roll date. Very convenient that there's a downturn in the market when GameStop has a big swap roll date, supposedly, purportedly, allegedly coming in. So it's possible, right? These two impetuses are at odds with one another as far as our technicals, right? Do we have enough support from buyers to basically keep us in this oscillating kind of range bound formation, or do we have a little bit more bearishness left in us? We might, but like I said, I wouldn't expect that until we see a lower low, a deeper lower low logged. What it looked like last week is, especially on Tuesday with that test of 26.33 and how quickly it was just immediately whatever institution entered into that short position to make that low value materialize, got out of it instantly because there just wasn't any momentum to continue to carry the stock downward. It went down basically as far down as they calculated it would go on the basis of their short, and there wasn't really any selling that accompanied it. And as I said last week, I think a lot of that had to do with the fact that, we moved up through this area so quickly. We found support in this 26 area again, all the way back after the Thanksgiving shorting. We moved from the 23, 24 area up through the 25, 26, 27 area very quickly. And didn't come back until that one kind of stutter period, a little bit of stuttering around earnings, but again, that was sort of earnings induced. Anytime the market's been open, that level has held as a pretty stable spot there. So the thing is, people who entered, or even institutions, right? Institutions entered when the price was way lower. But anybody who entered, even to kind of ride this trend, if they entered early, they entered it around, 22, 23, 24. Not very few people entered at around 25 or 26 because we spent so little time there. We moved so quickly up through that based on options-based moves that there aren't buyers, say, who are ready to capitulate based on moves to 26.50, something like that. That's what that seems like to me. That's what it seems like the charts are saying here with these technical levels. So again, that and we also had something like this last time. Like, this differs from the last Bank of Japan reaction. We had something similar, right? We dug pretty deeply and then immediately dug ourselves out of that, right? So there was most of the downside happened during the pre-market period, and then several hours before open, we just, we opened much higher and then shot back up basically to over $20, within the first hour or so of trading, and then traded up, back over 20 for subsequent, however many subsequent days. So we could see something historically, right? That's what occurred. So historically, that's not suggesting that, okay, deep downside still coming up, still in the future. Does that mean that can't happen? No, of course not, right? That's not what I'm saying. But in terms, from a historical perspective, from a contextual perspective, from a technical perspective, immediately, it doesn't look like deep bearishness is in the future. Now, is it slightly bearish? Or are we still getting kind of these forward-looking signals of there may be a little bit more downside left in here? Yes, right. That's on the board, but it's leaning toward finding some sort of stability, finding some sort of consolidation. I would say at least at this point above $25, maybe $25.50. So we could have a little bit more downside there over the next few weeks. I wouldn't be surprised to see something like that pop up. We do kind of have max pain values in terms of our options chain kind of peter out a little bit as we go forward, maybe about a month, 6 weeks. The next big date we're probably looking at to see kind of anything happen is going to be the 15th of February. This is when we're going to get the deadline for institutional filing. So we'll get some inklings as to what institutions did up through the end of the year. What were they doing with GameStop in November and December? Were they selling big? Like what was really going on there? So interesting to find out. As we zoom out a bit, right, into our, if we go to our daily chart, we still have a little bit. This is where kind of the 25.50 number is coming up. We have a historic support there. And we also have our 100-day moving average, although that's quickly eclipsing this kind of 25.50 area. Could we get something like 26? Yeah, of course, we can move back to 26, something like that. Kind of get an intercept there, find some support. We have, of course, something much deeper at 23.50, but on the basis of how we've gone, shorting, right? Yes, they can do like teleportation stuff like this to just like lightning us down. But, that stuff only sticks. Yes, okay, they can FTD stuff. They can kind of get the price artificially stuck in a certain range for, 30 to 40 days. They have to close those positions eventually. But really what ends up keeping the price down, right? They can't necessarily easily create infinite shares. Like they can do it, right? They can kick and they can juggle ETFs around. But it's there is a cost and there is risk for doing that. What really helps is when shorting can trigger selling elsewhere, either by getting, let's say, retail buyers to exit their positions, or by getting ETFs to rebalance in such a way, because, right, if they short it, then the market cap goes down. Then ETFs go, oh, okay, lesser market cap, the price is going down, not going to balance this as much, not going to weight this as heavily in this fund's portfolio. So then there can be some selling as a result of that. But if they can't get that kind of other momentum elsewhere, they can't build up that downward momentum in through selling in these other areas. If they can't, right, and it's not like people pile onto puts either, in particular, because of that IV dynamic in GameStop. This is what it seems to me. It tends to kind of hang out, right? The moves downward after you get these teleportations down tend to kind of consolidate for a while before something can be drummed up to kind of force it down again. I'm not going to put this past, right? We saw a lot of things in this bear market in that kind of cauldron in March of April last year, right? We've seen stuff like this happen, but I would say that recently, right, since the at the market offering, since GameStop's had a lot more capital, with the exception of, say, the earnings. With the exception of when we see at the market offerings, we don't see that same level of kind of wave after wave after wave of really heavy shorting, dragging the price down. As long as, especially if it's not tied to a significant degree of authentic selling. That's what it's looked like. to me, I would say, hey, but this is just what I this is just what I think. This is just what I see. Things can always be different. Yeah, and then at the weekly level, right? We're still, as I pointed out, all last week and even on our live stream there, we're still hanging out right on top of that trend line, weekly RSI trend line. That's that thing, right? Roaring Kitty pointed out this one back in the last time we had a big upward event. So that continues to be important. That continues to be held and respected. That's as far as a deeper signal that says, okay, well, imminent price collapse is not necessarily in the future. That's something I keep looking at. Maybe if we see that really abandoned, something like that over the next however many weeks, well, maybe it's time to reconsider. But while we still hold that, I'm not really in a state of oh no, gotta watch out. We're going back to 20. Not necessarily. And that's certainly a big marker for me. It looks like it was potentially one for Roaring Kitty as well when he was, continuing to try to support the bull case on GameStop all the way back in the fall of 2020, after we got some of these huge corrections in the midst of our uptrend, right? Like that October correction was big. The quarter 3 earnings report in December was a big correction. Like these are like 30 or 40% sell-offs in a matter of 3 days. But because we stayed on top of that weekly RSI trend line, Roaring Kitty was like, nope, we're not yet. So yeah, if go have a look at his tweets there. In terms of our options data, pretty light activity. Some call rolling into this week. Short calls at 30. A mix. Obviously, it's a mix between short and long, but we still have that as a huge OI position. Both traders, institutions betting on this expiring out of the money. Interestingly, yeah, we had a buildup of puts at 26. These were interestingly skewed toward the bid. So dealers are long these puts, meaning as that position is approached, they have to buy shares in order to hedge that position. 28 is a little bit more mixed, but that was very interesting at 26. We do have a lot of put OI at 26 for several weeks out. Max pain for this week, 27.50, again, projecting neutral. If we look at our gamma exposure data, yeah, we can see we've got some put buildup underneath us. 26 looks a little scary, right? We don't typically see this much in terms of put gamma accumulated on GameStop because it's so skewed in terms of calls due to that IV dynamic. But right, if we know that in the short term, these are skewed in terms of trader sold puts. So the dealers are long. So the dealers are buying shares again as that position is approached. Don't necessarily know what that looks like a few more weeks out, but at least in the short term, it's a little bit less slippery than these numbers would necessarily suggest, or less slippery than a similar value would suggest if this were SPY, with the reverse IV dynamic, of course. But with that being said, there just isn't a lot really until 25 in terms of even calls that are kind of open here. It's pretty neutral, slightly weak. There's not a lot of hedging support. So, if we continue to dig a little deeper in SPY, shorting can move us pretty quickly through here. But because in general, this kind of says, well, dealers are neutral. So there's not really much to speak of in terms of, oh, well, if we hit this level, then we'll start to slip through there. Not necessarily. And like I said, I think 26 is kind of deceptively, the put gamma at that level is deceptively mixed. That there's a little bit more. This is a more neutral strike than would be suggested by how much negative gamma our charts from unusual whales are necessarily saying. If we do move up again, looking back, we it just looks flat, right? Like we would really need something. We kind of have this 26, 29 sort of range. This is flirting as our sort of our lower bounds. 29-ish area, shy of 30, this kind of slows us on the way up. Of course, if we move into there, if 28 goes in the money, this value will go up. As we start to go up, traders might continue to buy calls there. I think 28 is going to function as more of an overhead on a lower volume, in a lower volume environment, I should say. If we do have some reason to pop back up, and because we're neutral, we would go pretty, gamma neutral here. We would, go relatively quickly compared to how we would trade in this range. I think at most, without some kind of major or meaningful event, get trapped back in this 28, 29 area and then kind of slip back, right? And of course, max pain might move up a little bit if we did that. So a little hard to tell right now, but again, it's just neutral, slightly bearish is the outlook. Not a whole lot to get excited about. We still see IV is bleeding. We hit a new low, 75% according to Schwab. Dip below 60% on the 10-day mean implied volatility. So that is most certainly the lowest value we have seen since prior to October 29th. That's the lowest value we've seen, interestingly. So continues to bleed down, but as we know, right, it was a lot lower back in the middle of October. It can still go down lower still. And with earnings not coming up until the end really of March, we're not going to see that earnings appreciation effect until about March 11th or 12th. If we're getting earnings on the 26th, maybe we get something mid-February to sort of stir something up in terms of institutions, maybe disclosing if they increase positions. That might stir some things up. But we've got a long stretch here, right? It's like 7 trading weeks before we can think of anything in particular that would cause, external that would cause IV specifically on GameStop to stir up beyond kind of institutions messing with some of these market maker hedging dynamics that we saw last week, or something like a Roaring Kitty tweet. So that's my outlook for right now. I know, maybe that doesn't sound as exciting as some other things that we've seen, but in this case, it's to stay vigilant. It's these boring times. It's like I talked about in the fall. It's the boring times. It's the times where nothing's happening that merit close inspection. It's these boring times where people are going, it's trading sideways. Nothing's happening, blah, 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 right? These are when the kind of smallest kind of drop in the bucket can send ripples that can generate some opportunities for outsized returns, especially if you're someone who's trying to trade the stock or to make, to increase profit on the basis of some of these small movements. These small movements are less risky, certainly when we see IV down, very, very much down, right? When the price is up, when IV is up, trying to trade options, trying to make things happen off of long calls is you can get trapped in a deeply unprofitable position, just like I'm sure a ton of people were based on this, like market maker shorting came in, or not market maker, but institutional shorting came in, dumped 1 million shares on the tape, not last week, but the week before, when nobody was expecting it, when nobody was hedged in the options market to capture that downward move that early heading into OPEX. So that type of stuff can happen. That vulnerability is a much greater risk when options are expensive, when calls are expensive, when IV is up. When IV is on its way down, that risk is still present. And long calls, single leg long options are still not structurally in favor of the purchasing party. They're still structurally in favor of the dealer. But there is comparatively less risk in a situation where IV is lower compared to a situation, as I should say, lower is closer to the lower, its historic lower bounds than it is compared to even when it's in the middle of the range, right? Not necessarily historic upper bounds like it was, back in May or June, but even the middle of the range, like what we saw with like 150%, which is unheard of in terms of a lot of other stocks. But that's happens a few times a year with GameStop, right? So yeah, very interesting. That's going to bring it to a close for today. Thank you so much, of course, everyone, for watching and listening. I hope you found this helpful. Hope you found some of these concepts we talked about useful. This is, of course, always for educational and entertainment purposes only. It is not financial or trading advice. But I want to thank everyone, of course, as always, for your support. Let's have a great week out there. I'm certainly looking forward to discovering what the future has in store. So thank you very much. We'll see you next time.